Welcome to our deep dive on how to reach a big cash goal, like saving $75,000 to $100,000 faster and with less stress. We'll walk through a proven decision framework for the debt versus savings dilemma, show you how to convert liabilities into cash flow, and map realistic timelines so you know exactly what it takes. Along the way, we'll use diagrams, a couple of quick quizzes, and step-by-step tactics to help you accelerate your results. Let's begin by setting expectations and issuing a quick disclaimer. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Everyone's situation is unique, including income, risk tolerance, debt terms, local regulations, and goals. Always verify current interest rates, account yields, fees, and any prepayment penalties. Consider consulting a qualified professional before making major financial decisions. With that said, let's outline our roadmap. Here is our roadmap for the session. First, we'll cover the foundation behind a strong budget. Next, we'll tackle the debt versus savings decision with a simple rule. Then we'll run through a car loan case study. After that, we'll identify high-impact cost cuts, followed by timeline math so you can forecast your path. We'll also cover ways to increase income. And finally, we'll test your understanding with short quizzes and wrap up with a focused action plan. Let's start with the foundation. In this scenario, you already have a monthly surplus of at least $1,000. Plus healthy retirement accounts. That's excellent. The core mission now is to convert liabilities into guaranteed cash flow and then direct that cash into your big target. For short-term goals and safety reserves, a high-yield savings account is appropriate, while long-term investing belongs in tax-advantaged or brokerage accounts aligned with your horizon. Be intentional about each dollar's job. Finally, the timeline is non-negotiable math. If you save $12,000 per year, $100,000 takes a little over 8 years. If you want to shorten that timeline, you must increase the savings rate, or the income, or both. With the foundation set, let's move into the central decision that accelerates everything. Here is the decision rule. If your car loan's APR is above roughly 5%, prioritize paying off that loan aggressively. Doing so converts a fixed monthly outflow into guaranteed cash flow. Eliminating a $7,500 balance with a $350 monthly payment immediately frees up $350 per month. That's comparable to a risk-free return equal to your loan APR, which most investments cannot guarantee. On the other hand, if your APR is low or 0%, maintain minimum payments, ensure you have a 3 to 6 month emergency fund in a high-yield savings account, and direct the remaining surplus toward your down payment goal. Be sure to confirm there are no prepayment penalties and that any extra payment is applied to principal. Now let's see how this plays out with numbers. Let's compare approaches. With the debt-first approach, when your APR is above 5%, your extra payments effectively earn a guaranteed return equal to that APR. Eliminating the car loan frees $350 per month, reduces risk, and simplifies your budget, which also builds momentum. By contrast, with the save-first approach, which is more appropriate at lower or 0% APRs, you maintain liquidity in a high-yield savings account while continuing minimum payments. This preserves flexibility for emergencies and near-term purchases. However, you must periodically compare your loan rate to your HYSA yield and reassess. Both approaches can work depending on the interest rate environment, but the decision rule keeps you aligned with the better risk-adjusted outcome. Consider a car loan with a remaining balance of $7,500 and a monthly payment of $350. You also have a monthly surplus of at least $1,000. If the interest rate is 8% and you aggressively apply both the scheduled payment and your surplus to the loan, you are putting roughly $1,350 per month toward the balance. Ignoring small interest adjustments, this would take about 5.5 months. With interest, plan on approximately 6 months. As soon as the loan is gone, you unlock $350 of monthly cash flow, which increases your savings capacity by more than 30% relative to the original $1,000 surplus. Immediately redirect that freed cash to your high-priority goal or to your high-yield savings account as appropriate. Next, let's quantify timelines at different savings rates. This table shows how long it takes to reach $100,000 at different monthly savings rates. At $1,000 per month, or $12,000 per year, you would need a little over 8 years, about 100 months. After freeing the car payment, $1,350 per month gets you there in roughly 6.2 years. If you also trim food and other discretionary items to reach $1,600 per month, you are at about 5.2 years. Pushing to $2,000 per month drops the timeline to roughly 4.2 years. These are straight-line estimates and exclude investment returns for clarity. The key insight is that cash flow improvements compound your speed. Now, where can we find those extra dollars consistently? Let's examine discretionary spending, starting with food. Food spending often hides easy wins. Plan a weekly menu, shop once for the bulk of your needs, and allow a small midweek top-up. Buy staples in bulk when unit prices are favorable. Choose store brands where quality is comparable, and keep recipes simple and repeatable to reduce waste. Use loyalty programs, rebate apps, and digital coupons to stack discounts. Aim to reduce a combined food spend of $375 to roughly $275 to $300. That frees $75 to $100 or more each month to redirect toward your goal. After tightening groceries, let's talk about growing the numerator, your income. To speed up your timeline further, increase income. Start by negotiating a raise with quantified results and contributions. If available, take overtime or premium shifts to increase near-term cash flow. Consider a focused side hustle with a clear hourly return, such as specialized freelancing or seasonal work. And track the effective hourly rate to ensure it is worth your time. Sell unused items to turn clutter into cash, and verify that you are optimizing taxes and benefits, particularly any employer retirement match, which is essentially free money. Balance these efforts with rest to avoid burnout. Now let's formalize the math with a quick markdown summary you can screenshot. Here is a reusable summary of the core math. The years required equals your goal divided by your annual savings. For example, 100,000 divided by 12,000 is approximately 8.3 years. At 19,200 per year, it is about 5.2 years. As a rule of thumb, when a loan's interest rate is meaningfully above 5% and your high-yield savings rate is lower, prioritizing debt payoff often wins on a risk-free basis. The code block groups the main scenarios so you can copy them into your notes. Now, to visualize the journey, let's look at a high-level timeline. This timeline illustrates the sequencing. In the first month, you audit the budget and set up automation, automatic transfers to savings, and automatic extra payments to principal where appropriate. During months 1 through 6, you aggressively pay down the car loan if the APR exceeds 5%. Otherwise, you keep minimum payments. In the first 3 months, you implement grocery and discretionary cuts. Between months 6 and 12, you complete a 3 to 6 month emergency fund if you have not already. From month 12 onward, you redirect the freed $350 per month, plus any grocery savings, fully into your goal. Around months 18 to 24, you pursue a raise, role change, or side hustle ramp-up to boost your income. From month 24 to 60, you continue rate checks, fee audits, and an annual tune-up to stay optimized. With the timeline in view, let's test your understanding with a quick quiz. Quiz time. Your car loan balance is $7,500 at 6% APR, with a $350 monthly payment, and you have a $1,000 monthly surplus. What is the best next move? Option A, aggressively pay off the car, then redirect the freed $350 per month to savings. Option B, put the surplus into a high-yield savings account first and ignore the loan until later. Option C, invest the surplus in high-risk assets hoping to beat 6%. Option D, do nothing because the payment is manageable. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is, aggressively pay off the car, then redirect the freed $350 per month to savings. At 6% APR, you effectively earn a risk-free return by eliminating the debt. Once the loan is gone, the monthly payment becomes permanent cash flow you can allocate to your savings goal. Now let's try another quick check on timeline math. Second quiz. If you save $1,600 per month toward $100,000, about how long will it take? Option A is 3.5 years, Option B is 5.2 years, Option C is 6.2 years, and Option D is 8.3 years. You may pause the video now to think through the math. We will discuss the answer in the next section of the video. The correct answer is approximately 5.2 years. 100,000 divided by $19,200 per year equals about 5.2 years. The broader lesson is that every additional dollar of monthly savings compresses the timeline disproportionately when compounded over years. Next, let's capture the most important lessons as key takeaways. Here are your key takeaways. First, if your APR is above roughly 5%, paying off debt first provides a risk-free return and unlocks cash flow. Second, cut where it counts, especially groceries and discretionary categories, to add predictable dollars without sacrificing essentials. Third, automate transfers and extra principal payments to maintain consistency. Fourth, the timeline math is non-negotiable. Your goal divided by your annual savings equals the years required. Finally, to achieve $100,000 in 5 years or less, plan to increase income or nearly double your monthly savings rate. Here is a focused 30-day action plan. First, audit every loan and bill, noting the interest rates, minimum payments, and any prepayment penalties. Second, decide your path using the APR rule, debt first if the car loan APR exceeds 5%. Otherwise, save first with minimum payments. Third, automate your transfers and extra principal payments, labeling each goal to reduce friction. Fourth, implement your grocery plan and start tracking unit prices. Fifth, free up cash by canceling unused subscriptions and selling idle items. Sixth, launch one income experiment and track the effective hourly return to confirm it is worth continuing. Finally, review monthly, reallocate new cash flow, and repeat. As we close, here is a quick summary. To wrap up, remember that your monthly surplus is your superpower. Protect it and grow it. Use the greater than 5% APR rule to choose between debt first and save first strategies. Eliminating a $350 car payment can boost your savings rate by more than 30%. Trim grocery spending thoughtfully and redirect every free dollar to your goal. Finally, compress the timeline by raising your monthly savings and, where possible, increasing income. Now a quick thank you and a request. Thanks for watching. If this video helped you, please like it, share it with a friend who is saving for a big purchase, and subscribe for more practical money strategies. In the comments, tell us your savings goal, your car loan APR, and one change you will implement this week. Your ideas might help someone else move faster. See you in the next video.